Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome back to part 2 of our video on uranium in unstable markets. In this part, we'll look at safer alternatives and the signals to watch if you ever reconsider uranium. Timing is tough because these stories don't arrive on a schedule. In unstable markets, investors often overreact first and ask questions later. Good reasons to avoid uranium exposure even if you like nuclear energy. If you're avoiding uranium it doesn't have to be a dramatic call. It can be a calm decision based on fit. Use this section like a quick checklist. It can be a rough ride if you need steady returns or quick access to cash. Uranium exposure can mean sharp drawdowns and long flat stretches. If you might need cash soon, that's a problem. Unstable markets have a habit of forcing sales at the worst time, like needing to replace a roof right after a storm hits your neighborhood. Liquidity can also be an issue in smaller miners. Some trade lightly, spreads can widen fast, and a good exit price might not be there when you want it. If your plan depends on quick access to cash, high volatility niche assets can add stress you don't need. A useful gut check is this. If a % drop would change your sleep, position sizing won't fix the issue. It's a signal the asset may not match your risk budget. Most investors do not buy uranium itself, they buy proxies with extra risks. Most people can't easily buy and store uranium. What they buy are proxies, each with its own baggage. Miners and producers. Operating costs, labor issues, grades, outages, and country risk can dominate returns. Developers. Permits, funding, construction risk, and long waits before any revenue. Royalty and streaming firms. Often steadier, but still tied to counterparties and project execution. Uranium-focused ETFs. Convenient, but often concentrated, a few holdings can drive results. These extra risks mean your outcome may not match the uranium spot chart you see online. A company can lag even in a rising uranium market because it issues shares, takes on costly debt, or misses an operating target. In a shaky market, that gap between uranium is up and my position is up can frustrate investors into bad trades. The nuclear comeback story is real, but timelines can be slower than your patience. There are real long-term tailwinds. Energy security concerns, carbon goals, reactor life extensions, new builds in some regions, and ongoing interest in small modular reactors. The story isn't imaginary. The issue is timing. Reactor projects and fuel contracting work on multi-year cycles. Utilities don't rewrite procurement plans overnight. Even when contracting improves, it can take time for better pricing to show up in earnings and cash flow. Valuation matters too. When excitement runs hot, future good news can get priced in early. If expectations rise faster than real results, even good updates can lead to sell-offs. That's a common pattern in theme trades, especially when broader markets are already nervous. If you are staying out, what to do instead, and what signs would make uranium worth revisiting? Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.